Most countries today, no matter how small or remote, have a central bank. But there are a few exceptions. Tuvalu, with a population of just 9,500, and Kiribati, home to about 130,000 people, don't have one. And yet, both of them still rely heavily on the Australian dollar for serious transactions. In other words, even countries without a central bank end up depending on someone else's. Because central banks, whether you like them or not, are the invisible engines that keep modern economies running. They act as the emergency backstop in a financial crisis, the inflation regulator, the bank for banks, and the steady hand behind every national currency. They're the reason your savings mean something, your debit card works, and the economy doesn't collapse every time there's a bad headline. So what happens if a country decides to get rid of its central bank altogether, like some people in the US are now suggesting? What would that mean for America, and the rest of the world, including countries like Australia that rely so heavily on a stable US dollar? The idea of abolishing the Fed recently, there's been growing political chatter in Washington about scrapping the Federal Reserve entirely. For some, the Fed represents unaccountable financial power. For others, it's the last line of defense against reckless economic policy. And while the idea of abolishing it sounds radical, it's actually not unprecedented. The US has done it before, twice. A very short history of central banks to understand how we got here. We need to rewind to when central banking first began. In the 1600s, European cities like Amsterdam and London were experimenting with public banks that managed city debts and issued coinage. These evolved into what we now know as central banks, most famously the Bank of England, founded in 1694, and Sweden's Riksbank, which still exists today and even awards the Nobel Prize in Economics. Their basic job was simple: keep the government's money safe, make sure banks could trade smoothly, and provide a single, reliable currency everyone trusted. When the US was founded, Alexander Hamilton created something similar, the first Bank of the United States in 1791. It was part government-owned, part privately funded, and meant to unify America's messy financial system. But it didn't last. Its charter expired in 1811, came back in 1816, and was then abolished again in 1836 when President Andrew Jackson declared war on it, accusing it of being too powerful and corrupt. That argument, whether a central bank gives too much power to too few people, would come up again and again throughout US history. The chaos that followed without a central bank, America's financial system descended into chaos. Every regional bank started printing its own currency. Some were reliable, many weren't. Imagine trying to shop across state lines when no one knows if your money is real. Forgeries were everywhere, and there was no single authority guaranteeing value. It all came crashing down in 1907, when a banking panic nearly collapsed the entire US economy. A group of wealthy financiers, led by J.P. Morgan, stepped in with their own money to keep the system afloat. That worked once. But it made one thing painfully clear: the US needed a permanent solution. So, in 1913, Congress created the Federal Reserve System, a network of 12 regional banks under one central authority. Its first job was simple: make sure banks never ran out of cash again. From bank runs to economic stabilizer over time, the Fed's role expanded. By the 1970s, it wasn't just a lender of last resort, it became the stabilizer of the entire economy. Congress gave it what's called the dual mandate: keep prices stable and maximize employment. In other words, make sure inflation doesn't eat people's savings, and keep as many Americans working as possible. Most other countries' central banks, including Australia's Reserve Bank, have similar goals, though the RBA adds a third: economic prosperity for all Australians. The tools of the trade. So, how does a central bank actually do all this? The truth is, it doesn't have many tools. In fact, it basically has two. The first, interest rates. When inflation is too high, the Fed raises rates. That makes borrowing more expensive, saving more rewarding, and slows spending, cooling the economy. When the economy slows down, it lowers rates, encouraging borrowing and spending, giving everything a boost. The second, open market operations. This is where the Fed buys or sells government bonds and other assets to adjust the amount of money floating around. During a crisis, like in 2008 or during COVID, the Fed can create new money and use it to buy massive amounts of bonds and securities. This floods the economy with cash in a process called quantitative easing. It's basically the break glass in case of emergency button for the financial system. The Fed's big problem, inequality and debt, but here's where things get messy. When the Fed pumps money into the system, it doesn't reach everyone equally. Most of that new cash ends up in the hands of investors, corporations, and wealthy households who buy stocks, property, and other assets, not groceries. So while consumer prices rise modestly, asset prices, homes, shares, and luxury goods, soar. And suddenly, the gap between rich and poor grows wider. This isn't just a moral problem, it's a practical one. Because now, when the Fed raises interest rates to fight inflation, it hurts middle and lower income families the most. Their mortgage payments, rents, and credit card debts all go up, while wealthy investors barely flinch. As a result, the Fed is now trying to control three economies at once: the one for ordinary people with debt, the one for wealthy asset owners, and the one for the government itself. And that's not easy. The tug of war between governments and central banks. In theory, central banks are meant to be independent from politics. Because no elected leader wants to raise rates or slow the economy before an election. But lately, that independence has been under serious pressure. In the US, the government keeps spending record amounts of money, even while the Fed is trying to slow things down. In economic terms, that's like one foot slamming the accelerator while the other hits the brakes. Australia has had similar tensions. The Reserve Bank of Australia spent years trying to cool inflation while the government rolled out major spending programs to boost growth. It's a delicate dance, and sometimes the choreography falls apart. Could the US actually scrap the Fed? Now, could America actually abolish the Federal Reserve? Technically, yes. The US Treasury could take over its responsibilities, managing interest rates, printing money, and stabilizing the economy. But here's the problem: it would no longer be independent. And when politicians directly control the money supply, history shows that things tend to go very badly. Take Turkey, for example. Its president forced the central bank to keep interest rates low, insisting that it would grow the economy. Instead, the country plunged into hyperinflation, destroying people's savings almost overnight. And without independence, the US could risk the same fate, because no politician wants to raise rates or cause a recession, even if that's what the economy needs. The Fed isn't perfect, but it works. Of course, the Fed isn't flawless. It makes mistakes, and it's under constant scrutiny from both economists and conspiracy theorists. But the reality is, the Federal Reserve is the most powerful financial institution in the world. Unwinding it would be nearly impossible without triggering chaos across global markets. Countries like Australia, which hold huge reserves of US dollars and rely on American stability, would feel the shock immediately. Exchange rates would swing, investment flows would freeze, and the entire global financial system, built around the US dollar, could unravel. So while it's tempting to imagine a world without the Fed, that world would likely be a lot more unstable than anyone realizes. Conclusion: central banks aren't perfect. They're bureaucratic, complicated, and sometimes make decisions that seem totally out of touch with everyday life. But they exist for a reason. Without them, money loses meaning, markets lose confidence, and economies lose control. So, could the US get rid of the Fed? Sure, but it would probably wish it hadn't. If you found this breakdown useful, hit subscribe, and let me know in the comments. Do you think the world would be better without central banks, or are they a necessary evil in modern economics?